Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 14, 2023 podcast. Today's podcast discusses an issue that should be on the radar of every developer, syndicator, or investor in low-income housing tax credit finance properties. We're going to be talking about the so-called adders to the investment tax credit for solar panels installed at affordable rental housing properties. By that, I mean provisions in last summer's Inflation Reduction Act that could increase the 30% investment tax credit for installing solar on an affordable housing property by as much as 40%. That's right. A low-income housing tax credit property could get as much as a 70% tax credit for the cost of installing solar. The reason why we're having the podcast now is the Internal Revenue Service recently issued guidance on a key provision to get those extra percentage points. In today's podcast, we'll discuss what we know now, and maybe just as important, what we don't know now, and we'll discuss when we think we might know the answers to some of the other questions. Now, there are three major provisions that can increase the 30% investment tax credit. Now, let me first remind listeners, though, that in general, to be eligible for this 30% investment tax credit, you must adhere to certain labor requirements that include paying prevailing wages, and you must follow certain apprenticeship program requirements. If you do not meet these two requirements, prevailing wage and apprenticeship, then the credit isn't 30%, it's 6%. Now, I did say in general, you had to meet these requirements because the labor and apprenticeship rules are waived for solar installations under 1 megawatt. And most solar installations at low-income housing tax credit properties are below 1 megawatt. So this does mean that most affordable housing properties will be eligible for the base credit of 30% without regard to the labor and apprenticeship requirements. Now, as I noted, beyond the 30% base credit, there are three major boosts to get an even higher percentage. The first is a 10% increase for domestic content. And by domestic content, I mean content sourced in the U.S. versus from overseas. The second is a 10% increase for being located in what is called an energy community. Now, while we can make some estimates, I don't like to say guesses as to what the requirements will be for those definitions, the IRS has not yet issued guidance on them. So those potential adders to the 30% credit are still a bit up in the air until such guidance comes out. Now, the third area, which is the area we're going to focus on today, because the IRS has issued guidance, they issued the guidance in February, is the adder that's commonly referred to as the environmental justice bonus. The environmental justice bonus includes a 10% and a 20% adder under the Low-Income Communities Bonus Credit Program. Now, this 10% or 20% adder, the cumulative amounts are subject to a cap of 1.8 gigawatts. Now, if there's a cap of 1.8 gigawatts, that then means that property owners need to compete in order to receive an award. Now, it's important to note that eligible properties include more than just low-income housing tax credit finance properties. And many of our clients who are developing properties outside of low-income housing tax credit financing will be applying as well. So that means that LIHTC developers and others will be competing for this bonus with all different types of properties. We'll discuss more on that later. That's one of the purposes of today's podcast. Now, the guides released by the IRS last month specifies how much capacity will be allocated to affordable housing, as well as broad plans for the application process. To get a bit more specific, there are 4 types of installations that will be eligible to compete for the 1.8 gigawatts of solar capacity. And before the guidance came out, we didn't know how much would go to affordable housing versus the other categories. I will also note that the IRS in their guidance did also promise forthcoming guidance within the notice, which is further evidence that there's a lot more details to come before the application process can open up. That said, the information was enough to allow developers, owners, syndicators, and investors to begin considering how they will approach the competitive part of the process. And that's what we're going to talk about today. There's a gating question for developers. Should I or should I not keep the optionality of applying for these credits in my capital stack. My guest today is Dirk Wallace. Dirk's a partner in Novogradac's Dover, Ohio office. Dirk's been a frequent guest on Tax Credit Tuesday and does lead our low-income housing tax credit working group. He works in many other community development tax incentive areas as well, is a frequent speaker at our conferences. Dirk works extensively with all sides in low-income housing tax credit property transactions and has been paying very close attention to the guidance that we've received. Now, in today's podcast, Dirk and I will discuss the key points of the guidance, including how much capacity will be awarded to affordable housing properties. We'll discuss how many developments we expect to receive the bonus credits, as well as potential timeline for applying for the bonus. We'll also look at what developers, syndicators, and investors should be doing now to get ready for those applications and how Novogradac can help. Importantly, Dirk and I will also talk about what we don't know yet and what additional guides we're waiting on and when we might receive it. As you can tell, there's a lot to talk about. So if you're ready, let's get started. Dirk, welcome back to Tax Credit Tuesday.
Yeah, it's great to be back, Mike.
Always good to have you. You're a very popular guest.
Great to hear.
Now, before we get to the guidance on, the solar credit, the bonus, there is another energy efficiency incentive that was extended for 10 years by the Inflation Reduction Act last year. And that, of course, is the Section 45 Cap L Energy Efficient Home Credit. Please share with our listeners how that provision was changed by the Inflation Reduction Act, as well as what the significance of the 10-year extension is.
Well, it's interesting you said it's been extended for 10 years because everybody's saying it's this new credit out here. It's just, it's just a new thing. And I'm like, no, 45L's been around for a long time. It's just maybe not been as useful as it is now that the Inflation Reduction Act gave us these changes, which are great. So to kind of get into those changes, I guess prior to the Inflation Reduction Act, the 45L credit, it was maybe extended for a year. Most of the time it was retroactively extended. So when you're working on a property that takes 2 years to build, or two or 3 years to build, planning for something that doesn't exist, or you're hoping on it being retroactively extended, just wasn't feasible, and it's just not really how the industry works and forecasts these transactions. So, when looking at the Inflation Reduction Act, what it did is it first looked at the energy standards, and it's, okay, we're using energy standards from 2006. Maybe those need to be updated a little bit. So the new energy standards are Energy Star, which I think most people are familiar with, or the Department of Energy's Zero Energy Ready Home Standards, which are, as it sounds, more strict than just Energy Star standards. So if you are qualifying for Energy Star, your credit could be up to $500 per unit if you don't use prevailing wage, or if you use prevailing wage, it can be up to $2,500 per unit. And that's a significant change. It used to be $2,000 per unit. Again, $500 is lower, but the $2,500, I think, would help some investors out or some developers out that have to use prevailing wage. Now, if you go the Zero Energy Ready Home route, the credit doubles. So you can get $1,000 if you don't use prevailing wage, or $5,000 if prevailing wage applies to your project. Now, talking to a lot of developers, we're in this rising interest rate environment, looking at the types of financing that they're going to receive. A lot of developers are using HUD financing. And if you're using, say, a 221D4 loan, well, that requires prevailing wage. So you may be sitting there saying, I could qualify for a $2,500 credit per unit or a $5,000 credit per unit without really knowing I qualify for it. There's not an application process. That's what we call an as of right credit. And, more importantly, when looking at state standards and in states that are, working energy efficiency into their QAP, their Qualified Allocation Plan, a lot of times we see at least Energy Star being incorporated into Qualified Allocation Plans. So, we have developers, again, that maybe have not heard of 45L. They may, you may be leaving some money, some credits and equity on the table by not knowing that you can qualify for a significant amount of credit per unit.
So thank you for that, Dirk. That's it's not going to make or break a development from the beginning, but definitely can close some financing gaps. And as you pointed out, with rising costs and the rest, every little bit helps. I will include a link to a podcast we had last year with our fellow partner, Brett Parker, that was specifically on 45 CAPL. But I did want to, since we're talking about energy efficiency and the rest, I thought it was important to mention that before we get into the details of this podcast. So let's start our deep dive into the guidance IRS issued in February. Once again, this is the guidance on how taxpayers can apply for an extra 10% or 20% in solar credits for light tech and other qualifying properties. I guess I should be a little more accurate, increase their credit percentage by 10% or 20% of the cost of the qualifying property. You don't get theoretically 10% more, the 30%, which would be 6%. But anyways, I go off on a tangent. So Dirk, please explain how the IRS is planning to allocate the 1.8 gigawatt cap among the various qualifying applicants or properties.
Sure. Well, as you mentioned, it's a 1.8 gigawatt cap. So when kind of looking at the guidance, or actually kind of taking a step back and looking at the Inflation Reduction Act, it was somewhat vague in saying, there's this 10% bonus for low-income communities. There's this 20% bonus for affordable housing and low-income economic benefit projects. And all of that's going to be subject to this 1.8 gigawatt cap. And that was the first question. How is this going to be allocated? So I like to look at it and say, okay, the first thing they did is they took the 1.8 gigawatts and they split it in half. And they said 900 megawatts went to the 10% bonus and 900 megawatts went to the 20% bonus. And then you look at those individual bonuses, and within the 10% bonus, there were two categories, category 1 and category 2. So in category 1, it was a 10% bonus, and that 10% bonus was allocated 700 megawatts. And that was for installations that were located on low-income communities. And in the remaining 200 megawatts was for installations located on Indian land. So you had 700, 200 equals the 900 megawatts, and that's for categories 1 and 2. You now look at categories 3 and 4, and similar methodology was done for categories 3 and 4. They took the 900 megawatts, divided into two categories, 700 megawatts and 200 megawatts. Now the 200 megawatts is category 3, and that goes to affordable housing programs such as the LIHTC program, Section 8 properties, these federal covered housing programs that would fall under category 3. Then the 700 megawatts were for installations in qualified low-income economic benefit projects. So these are installations that benefit low-income communities. And you add that all up and you get the 1.8 gigawatts. Now, if one category is not used, there are reallocation provisions where it can be reallocated to the other categories. It doesn't say if you could take, say, a category that has a 10% bonus and reallocate it to a 20% bonus. It doesn't really talk about that. It just says unused allocation will be reallocated at some point.
So the 4 categories that you mentioned, could you maybe, just for the benefit of our listeners, just list the 4 categories again?
Sure, absolutely. So category 1 would be installations in a low-income community. Category 2 is installations on Indian land. Category 3 are installations on low-income residential building projects. In category 4 are qualified low-income economic building benefit projects.
So thank you for that. One of the reasons why I asked you to do that is the listeners now can hear you listen to those 4 categories and think to themselves, wait a second, what? But it falls into more than one category. A clear example would be a low housing tax credit property in Indian land.
Mm-hmm.
What'll happen in those circumstances where a particular proposed development would qualify for more than one category?
Sure, and the guidance actually does address this, which I think is great. So, kind of going back to the categories, first thing you would look at where your project is located, and if it's on Indian land, that falls in category 2. So that's the 10% bonus. But because it's a low-income housing tax credit property, it would fall into category 3 as well. Now, the guidance does say if you are in categories 1 or 2, and you also qualify for in 3 and 4, then you have to apply in either category 3 or in category 4. You can't apply it for both. You can't pick and choose. If you qualify as a 3 or a 4, a category 3 or 4, you would have to apply in one of those categories. Now, I do pick up something new. I feel like every time I read this, it's on my daily reading list. I'm always going back and revisiting the guidance. Now, it does not comment on if you qualify in both 3 and 4, if you have to go to, if you can, I guess, stay in category 3 or stay in category 4. It doesn't automatically put you in one of those categories. So you can pretty much apply for whichever category you want if you qualify for 3 and 4. Meaning as long as you stay in 3 and 4.
And you would think most, if you're 1 or 2, that's 10%, 3 and 4 is 20%. So most would want to be in the 1 to 20% instead of 10% anyway, I guess, unless you thought the competition was going to be so great that you thought there'd be greater assurances. And right now that's going to be hard to assess, but more on that in a bit. So Dirk, before we get into some of the specifics about the timeline, I'm sure some listeners are interested in assessing how competitive they think the application process will be. And one way that I think of to assess the level of competition is to try to estimate, well, how many developments I think will get an award of like new market tax credits, roughly, half the applicants receive an award. So that's a way of assessing the degree of competitiveness. Obviously, we don't know how many applications there'll be, but you mentioned that there was 200 megawatts allotted to the category that low density taxable properties would be competing in. So how many different developments would you estimate will get an award? And I want to ask you for a point estimate. Range is acceptable.
Yeah. As soon as this guidance came out, I started talking to developers, especially that have put solar installations on their LIHTC properties, and just to get a sense of how big an installation is. How much roof space do you have? A lot of it goes into how much of that, 200 megawatts you would use. And the feedback I've been getting is the average size is around 100 to 200 kilowatts. For the non-energy experts on here, like myself, you have 1,000 kilowatts in a megawatt, and then 1,000 megawatts in a gigawatt. So if you're looking at a 100 to 200 kilowatt installation, that 200 megawatt capacity could roughly be allocated to 1,000 to 2,000 low-income housing tax credit projects, which, I think is pretty significant, for the 200 megawatts. And when I started looking at categories 3 and 4, and category 4's got 700 megawatts, that's got to be where I want to apply, right? Talking to kind of solar developers who say, well, if we do a standalone installation, it's not going to be 100 kilowatts. It might be a megawatt, 2 megawatts, maybe 5 megawatts.
Right.
So that's 700 megawatts may only finance 700 installations, where the 200 megawatts could finance or could be allocated to 1,000 or 2,000 residential projects.
Great. That is super helpful. Thanks for that context. Now let's talk about the timeline. You noted the guidance calls for applications to begin in the third quarter of 2023. Now, I don't think it's just me. Seems pretty late in the year to begin applying. Developers have their developments, they're applying for their tax credits. There's a variety of other development factors going in. And if you don't even apply until the third quarter of 2023, you won't know, presumably, until later in the year. So what are you sharing with developers in terms of how to weave this application cycle into their development performance?
Mm-hmm. Yeah, and I think that's a big concern. We are helping developers and syndicators underwrite properties that won't be placed in service for 2 years, 2 or 3 years. So, obviously time is of the essence. You have this third quarter period, which, July 1st would be great if they start the application window. September 30th, not so great. And it could be anywhere in between there, given the third quarter timeline. We do know it's going to be a 60-day window, a 60-day application window. So kind of worst case scenario, September 30th, it opens, 60 days puts you at November 29th. There's a lot of holidays kind of towards the year end. So I think that's where the concern comes. Wow, we may not know until 2024 whether or not we receive this allocation. And then the question also is, how long after the application window closes are they actually going to announce the awards? Is it going to be a lottery system? That was mentioned possibly in the guidance. Is there going to actually be a scoring system? A lot of this we don't know. And I think that's what concerns a lot of developers the most, is not only timing, but how's the application process even going to be administered, and how's the awards going to be allocated?
Got it. So if I'm a developer listening to the podcast, I'm thinking to myself, okay, thanks, Dirk. You give me general guidance, but I can't yet apply for these additional credits. What should I be doing now to prepare to apply? Or is there something that maybe would cause me to think I shouldn't bother preparing to apply?
I think step one is know how big of an installation you're going to have. Talk to your engineers, your architects, kind of get everything in order to, whenever you do apply, do you need 100 kilowatts? Do you need 200 kilowatts? Because once you put that application in, you can't go back and ask for more. And, we assume there's going to be a lot of competition. So I know a lot of developers and syndicators are underwriting it the base 30%, and then starting to look at, okay, should we maybe tweak some adjuster language in our partnership agreements, in anticipation of getting that 20% adder, to the solar credits.
So thanks for sharing that. It's probably worth noting at this point, just to remind listeners that for LIHTC developments, in addition to being eligible for the 30% on the cost of solar and this potential 20% boost, to the extent you have a 9% transaction with excess basis, the costs are also eligible for the 9% log of the tax credit. And if you're in the 30% boost area, it'll even be eligible for the 30% boost. And if you're doing a tax and bond finance transaction, you'll be eligible for the 4% credit, potentially up to a 5.2% credit because of 30%. And there could be some adjustment to that credit a little bit because of some of the financing rules that relate to solar and private activity bonds, but that's a whole other podcast too. But just wanted to note, when you're underwriting the inclusion of solar in a LIHTC development, there is this additive nature, which is really driving many developers to be considering solar where they've thought about it in the past, but haven't seriously considered it. And now they're giving it very serious consideration.
Mm-hmm. And then one thing I forgot to mention, the 45L and the solar credit, as you alluded to, there's no longer that eligible basis reduction. Before you reduced eligible basis by the amount of the credit for 45L and then 50% of the credit for solar, the Inflation Reduction Act removed those, removed those reductions in basis.
So thank you for that. So developers and property owners, are, as I noted, because of the benefit of potentially including additional LIHTC credits, but, at a minimum, even if it's just additional solar credits, they're using these tax credits to try to help close financing gaps, which means they plan to raise additional equity from syndicators and investors for these solar credits. So if you could share with our listeners what types of issues or concerns syndicators and investors may have if they're committing to invest additional equity for these adder credits. I suspect there's not that many issues with the 30% because that is pretty straightforward in terms of the eligibility, but the 20%, particularly if they're talking to investors or syndicators now, they won't know if they're going to receive an award of this 20%.
Mm-hmm. Yeah, there's a few things to kind of look at it when we look at it from a syndicator investor point of view. First one, I think we maybe touched on a little with the adjuster language. Some adjusters are capped in certain funds, making sure that there's room to, pay for the, additional credits and get that equity into the projects. Also, if you're an investor that maybe has only invested in low-income housing tax credits in the past, you've never invested in solar credits, you might now start seeing a lot more of these renewable energy credits. Make sure that as a company, you have the approvals and authorization to, make the investment. Maybe it was just a small percentage and, you didn't really worry about it before, but these are, larger percentages now and more meaningful credit. Make sure that all of the approvals are in place so you can act quickly. Property that comes, across your desk for an investment. You don't want to be the last one to act to get all these approvals because you may actually lose the opportunity to, to submit an LOI or to invest in that if you don't have the proper approvals in place kind of going into the transaction.
I'd also just remind developers that the investment credit is claimed when the property is placed in service, as opposed to with low-income tax credits is actually leasing up the property and the like, and you'll get a partial year in the first year, all the rest, or you'll get 100% in the year you place the property in service. So from a yield perspective, it's certainly beneficial to be front-loading those incentives. So I did want to ask you a question that isn't covered in the guidance. You're like, great, Mike, it's not covered. You're going to ask me about it? And not to say that some of the other questions weren't hinting at questions that weren't answered in the guidance, but the legislation says that these additional credits, the 20% or 10% bonus, need to provide a financial benefit to the tenants of the affordable housing properties. So what are some of your thoughts as to how that measuring of that financial benefit will be calculated or determined?
Yeah, there's been, a lot of comment letters that have been submitted on, what developers would like to see or what could benefit the tenants. As we talked about, this is additional equity. Could, additional services be offered to the tenants? So maybe some social services. Some, things that wouldn't be that the developers wouldn't be able to do had they not had this additional equity in place. Obviously, the lower utilities is a big thing. I think the assumption is solar is cheaper than using renewable energy. So, lower cost of utilities to the tenants would be one financial benefit. It could be there as well. But yeah, I think overall, this is one piece that developers are really looking for because it is a requirement to provide this financial benefit. And as you mentioned, the term forthcoming guidance was put in this section, as well as, 5 or 6 other times throughout the guidance.
Great. Thank you for that. Now, we said forthcoming guidance a lot of times, and we know there's forthcoming guidance on the 20% adder. There's also forthcoming guidance on domestic content, as well as on energy communities. So the $64,000 question, when do you think we might get that forthcoming guidance?
Mm-hmm. So with the domestic content, for that, it's harder to speculate for me because I'm not a manufacturing expert. So I don't know. I do hear that steel maybe moves, throughout maybe a few different countries or maybe starts overseas and comes to the US. And, there's a lot that goes into the manufacturing process. And I think that's what a lot of people are waiting to find out, what is domestic content based on where it's manufactured or is it the end manufacturing. As far as energy communities, there is somewhat of a map that's out there. It's not very specific as far as individual census tracts. You can get a general idea, of brownfield sites and other certain qualifications where you can maybe start to make some assumptions based on the guidance that is there. But yeah, it would be really great if there was some type of map where you could just type in your address and say, yes, I qualify.
Yeah, well, so certainly, come at some point.
Mm-hmm.
So before we wrap up, what else should our listeners know that we haven't talked about during the course of the podcast with respect to this issue? Because there are so many issues you could be telling listeners that you would think they should know.
Well, like with any application process, details are going to be important. So when the application comes out, we've been in the details, we've been reading the guidance, we've been submitting comment letters. We can provide a lot of value when that application does come out to, kind of put you in a position to, best get an allocation. So I would say, as soon as we have guidance, further guidance in that application process is started, please do reach out. We'd be happy to help and find out what category your property might fit into, and then apply from there.
Great. Thank you for that. Something tells me when the guidance does come out about applying, there might be another podcast in our combined futures, as well. I could see us having a webinar on the application process, because obviously we help lots of clients with, the applications for productivity bonds and for credits associated with the bonds, the 9% credits, with the CDFI fund, including, new market tax credit applications and all the rest. So we at Novogradac have lots of experience working with clients who are helping clients apply for various tax incentives. So this is definitely in our wheelhouse. So to our listeners, I will provide Dirk's email address in today's show notes. And Dirk, please stick around for our off mic section, where I get to ask you some off-topic questions that our listeners are sure will find your answers useful. Engaging and entertaining, if not useful.
Exactly.
And also to our listeners, be sure to tune into next week's podcast. My guest is going to be my partner, Warren Sebra, and he's going to discuss the historic tax credit and how it can quite effectively be used in combination with other tax credits. And the other tax credits that you often see the historic tax credit combined with is the low income housing tax credit, the new markets tax credit, renewable energy tax credits, and the opportunity zones incentive. My partner Warren is going to discuss the benefits to developers from pairing these types of tax incentives and how layering these incentives together improves the capital stack, which can allow developers of historic properties to actually raise the total amount of equity they need to finance their developments. As such, if you're a developer and investor in historic tax credit properties, you'll certainly want to be tuning in. So now we've reached our off mic section, where I ask our guests some off topic questions to get their words of advice and words of wisdom. So Dirk, we're in the midst of busy season, and thank you again for taking time out of busy season for joining me on the podcast. And we have lots of interns who are starting their career in accounting. What advice would you give to someone starting their career in accounting?
Well, the first piece of advice is, if you're not working in Novogradac, apply.
There you go. Here.
Reach out to one of our recruiters. But normally I tell people starting out, you've graduated or you're about to graduate. The CPA is very important in our industry. Just keep at it while you're in the studying kind of routine. And just try to knock out that CPA as soon as possible. It's very, very useful, not only in public accounting, but outside of public accounting. People see CPA and, they want to see that certification. So I always tell people, keep studying.
That's great advice. I don't know if you had the experience, but when I took the CPA exam while I was working at now a Big Four, or a large accounting firm. I guess it was, I can't remember how many were there at the time. I guess might have still been the Big Eight. But it was amazing to me how quickly the test taking skills were deteriorating. Which on the one hand, it's sort of like, well, those skills are ever very useful. On the other hand, if they're deteriorating, you want to take the test as soon as you can before they deteriorated too much. So that's good advice. The other advice I always like to give to those new to the profession, and really at any point in the profession, is constantly, expanding your horizon through outside reading and the rest. Because obviously the business is all about sort of what you know, and you have to do a lot of ongoing reading and the rest to stay current, which is obviously one of the joys of public accounting, is the fact that things are always changing. So we're recording this during busy season. I already thanked you for making time for us during busy season. But how do you maintain sort of a work-life balance during busy season?
We usually set aside at least one day a week to on Saturday, where we plan something. Either we're going out to dinner or just some type of activity. and kind of sticking to that, unplugging, maybe not taking the phone with you, just, something like that where you can. So Saturday at 7:00, you might not be able to get a hold of me. But yeah, really just kind of making sure you set aside some time for yourself and to be with your family. And that's a consistent time always works. And that usually is on Saturday nights.
Good advice. Thank you again, Dirk. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes. You can find related links referenced in this podcast in our show notes at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.